Welcome back to The Deep Dive, the show where we really try to cut through the noise and get you those essential insights fast. Today we're driving into something that, well, it's captivated people for ages, the market. You know, for so many, it's this huge, glittering ocean of opportunity. It promises like unlimited wealth, that siren song of quick, easy money. It's the ultimate dream of financial freedom, isn't it?
It really is. And you know what's fascinating about our deep dive today, it's based on Mark Douglas's book, Trading in the Zone. What's fascinating is it reveals this kind of startling truth.
Which is?
That the real battle, the real market, it isn't about the external charts or, the economic reports. It's actually an internal landscape. It's a psychological arena inside each of us. And this deep dive, it's really tailored to help you, the listener, understand this often counterintuitive internal game, because that's what truly defines consistent success in trading.
Absolutely. And Mark Douglas, he's a really seasoned trading coach.
Yeah.
Been doing this since, 1983. He's worked with everyone, floor traders in those crazy pits, right down to people just starting out.
Yeah, seminars worldwide, consulting for big firms.
Yeah.
He's seen it all.
And his book, Trading in the Zone, it genuinely feels like the culmination of decades of thought and research. It's a real gem, I think, especially if you view trading as a profession, not just like a casual thing.
Definitely.
He even kicks off the book with this attitude survey. It really pushes you into self-reflection, like right from page 1. It makes you ask that question, what if the real market isn't out there at all? What if it's right here between your ears?
That's such a profound question, and it's exactly where Douglas starts. His work just meticulously shows that the biggest hurdles to consistent profit, they aren't about having the perfect system or the latest data feed. No, they stem from our own ingrained ways of thinking, our deep-seated beliefs and attitudes. These are like the hidden forces, They can either push us towards success or just lead to constant frustration and, losing money.
So let's go back a bit. Maybe think about, say, 1978. Back then, the prevailing wisdom, like the only proper way to trade, was fundamental analysis. You'd be poring over every possible variable affecting supply and demand, interest rates, company balance sheets.
Oh, yeah. Even weather patterns for commodities traders, it was intense.
Right. And technical analysis, studying price patterns, that was often just dismissed.
Totally. Mystical hocus pocus, they called it.
It sounds almost funny now, but that was the absolute dogma back then.
It was. And Douglas points out a really core problem with just relying on fundamentals. Intellectually, it makes sense, right?
Yeah.
Build these complex models, but they almost never factored in the traders themselves as variables.
The human element.
Exactly. Prices move because of people. People expressing beliefs, hopes, fears. Not just cold, hard math. You had influential traders, especially on the futures floors, acting on gut feelings, intuition, pure emotion sometimes, not balance sheets. And this creates what Douglas calls a huge reality gap. The gap between what should happen according to the model and what is actually happening.
Makes sense.
And that gap makes consistent prediction based only on fundamentals incredibly tough. Your prediction might be right eventually, but the ride there could wipe you out.
Then things shifted dramatically.
Yeah.
What was the big driver?
One word. Money. Figures.
Yeah, actual profits. By the late 70s, early 80s, technical analysis, just studying the market action itself, price and volume started getting widely accepted.
A total paradigm shift.
It was a revolution, really, and for good reason. Technical analysis looks at collective human behavior patterns. It saw that people tend to react in predictable ways under similar circumstances.
Patterns repeat with statistical reliability. Yeah, observable patterns. This lets traders kind of get into the mind of the market, anticipate what's likely next based on the past. Douglas argues it was way better than pure fundamentals because it focuses on what the market is doing now in relation to what it has done.
Closing that reality gap.
Precisely. And it opens up this unlimited number of possibilities across all time frames, day trading, long term, whatever. The market becomes this endless stream of potential setups.
Okay, so if technical analysis is so great, offering all these opportunities, why did the focus shift again? This time to mental analysis, individual trading psychology. That implies there's still this deep dissatisfaction, right? A gap between the perceived potential and the actual results. Even with better tools, people are still struggling. What's going on?
It's because the consistent winners, the truly successful traders, they are fundamentally different from everyone else. Douglas uses this really powerful earth and moon analogy. Anyone can place a trade, right? Call themselves a trader. Like, Earth and the moon are both celestial bodies. But the consistent winners, they're as different as night and day from the majority who struggle.
Wow.
He says getting to the moon, that's achieving consistent success. It's possible, but extremely difficult. Only a handful of people have really made it. The market does make vast amounts of money available, but that money, the stuff that seems seemingly within grasp, it's only accessible at will for those who've broken through this threshold of consistency.
And that threshold is mental, not analytical.
Exactly. It's a mental barrier.
That's a huge distinction. And it really drives home that most traders don't just fail to get there. They experience a lot of pain first, both emotional pain and, financial pain, before they can even start developing the right mindset. Douglas describes the journey as chock full of paradoxes and contradictions. Paradox seems like the word for trading.
It really is.
So what's the core paradox trapping most people?
The central one is our natural aversion to being wrong, to losing. Consistent winners, Douglas sees. They trade without hesitation, without internal conflict. They can freely admit, okay, this isn't working, and exit, even with a loss.
And feel okay about it.
Without the slightest bit of emotional discomfort. That's the key. It means they fully accept the risks inherent in trading. Because trying to avoid risk, which is unavoidable in trading, well, that will have disastrous effects on your results.
Right, the market will move against you sometimes. You can't avoid it.
Exactly. The paradox is our ingrained instinct to avoid that pain being wrong, losing money, is the very thing that stops us getting what we want.
Okay, this is where it gets really interesting. That natural tendency we all have, avoiding being wrong, avoiding loss, the thing that seems so logical, so protective, that's precisely what makes trading so damn hard. It's a fundamental paradox. How do you stay disciplined, focused, confident when you're facing constant uncertainty? How do you operate effectively when anything can happen, but you still need a plan?
The key, Douglas says, is learning to redefine your trading activities in a way that allows you to completely accept the risk. He calls this the most important skill you can learn. More vital than any analysis method.
Wow, more important than analysis.
Yeah, because without that radical acceptance, market information itself can become painful, and that triggers all the common errors. Jumping in too soon, waiting too long out of fear.
Not taking losses.
Right, letting small losses become huge ones, or cutting winners way too early. Or, just as bad, letting winners turn back into losers.
Yeah.
These aren't analysis mistakes. They're internal. They come from inappropriate attitudes, deep thinking patterns. Understanding this internal source, Douglas argues, is as fundamental to trading as learning how to serve is to tennis.
So without that mindset, even the best analysis won't lead to consistent money.
Exactly. The foundation isn't solid, #Tech2, the lure and the dangers of unlimited freedom.
Okay, so if that's the core problem, what's the deep underlying pull? What's the true underlying attraction to trading? It often feels like it's more than just the money. Douglas says it's the unlimited freedom of creative expression.
A freedom of expression that has been denied most of us for most of our lives.
Yeah. No boss, no rules, or so it seems. No limits on how you play the game. It sounds amazing, right?
It really does. The possibilities are virtually limitless.
Yeah.
Douglas mentioned someone at a seminar calculating over 8 billion possible spread combinations, just using bond futures, options, and cash markets.
8 billion. Seriously.
Yeah, and that's before you even factor in timing and risk variations. It's infinite, practically. This totally unrestricted environment, the ability to do whatever you can dream up, that's the ultimate lure for many. Be your own boss, strategist, risk manager, total freedom.
But then, why does having access to that unrestricted environment lead to, well, pretty consistent failure for most people? That seems like a total contradiction. If freedom is the goal, why does unlimited freedom in trading so often ends in disaster?
Because Unlimited possibilities coupled with the unlimited freedom present the individual with unique and specialized psychological challenges. Challenges that, frankly, very few people are equipped for or even know exist.
So we're just not built for it naturally.
Not really. Most people need to make significant mental adjustments to build an internal mental structure. This internal structure is crucial. It balances the huge freedom the market offers with the very real potential for, serious financial and psychological damage. Without those self-imposed internal rules, we're just not equipped to handle the market's boundless indifference. It doesn't care about us.
And building that internal structure is made even harder by what Douglas calls a backlog of mental resistance that starts way back in early life. So it's not just about learning new trading stuff. It's about unlearning deep, often subconscious programming. How does that early life stuff mess us up in trading?
That's spot on. We're all born into social structures, families, communities, whatever, and they all have rules, restrictions, boundaries. They're codes of behavior meant to keep things orderly, keep people safe, limit expression for the group's sake.
Yeah.
But this often clashes directly with a child's natural curiosity, that inner directed force driving them to explore, learn, follow their natural attractions, their passions. So you get this inherent drive for self-expression hitting up against external rules, leads to conflict.
Yeah, you can picture it easily, like a kid who's super artistic, just loves drawing, but born into a family obsessed with sports. They're pressured to conform, play ball, even if their heart isn't in it. Huge inner conflict. And what are the long-term dangers Douglas sees in these denied impulses?
He calls them dangers. Think about a toddler reaching for a vase. What happens? No, don't touch that, right?
Yeah, happens all the time.
That creates emotional pain and imbalance. Their need to explore that mental vacuum of curiosity gets shut down. Douglas says nature abhors a vacuum, and it applies to our minds too. Unfulfilled desires create these voids, unreleased energy. By the time we're adults, we've got thousands of these denied impulses stacked up, things we wanted, needed, wanted to express, but couldn't.
So what happens to them? They don't just disappear, right?
Not at all. Douglas says they accumulate and usually end up manifesting themselves in any number of addictive and compulsive behavior patterns.
Wow. And that directly messes with our discipline, our consistent approach to our trading.
Absolutely. It's like this hidden program running constantly, subtly sabotaging our best intentions, often without us even knowing why.
Okay, this connects directly to why trading is so tricky compared to, say, gambling. Trading, unlike structured games, lacks those built-in structures or safeguards that force discipline on us.
Exactly. There are some key differences.
Like what? Give us an example.
Okay, take blackjack. When you sit down, you have to decide your bet, your risk, before the cards are dealt. It's forced.
Right, it's part of the game.
In trading, no one, except yourself, is going to force you to decide in advance what your risk is. And consistent losers, they instinctively avoid defining risk because it makes them face the real possibility of loss, which leads to distorted thinking like, this trade can't possibly lose, making risk definitions seem pointless. The market doesn't impose discipline. You have to.
What about, like, clear beginnings and endings? Gambling games have those, too.
Precisely. Blackjack hands end, dice rolls end. There's a clear conclusion. Then you consciously decide, bet again, or stop. Trading, it's in constant motion. No forced endings. You decide when to get in, how long to stay, when to get out.
Which sounds great, but
that openness means any number of psychological factors can come into play. You get distracted, change your mind, get scared, get overconfident. It leads to erratic behavior. In gambling, you're an active loser. You choose to bet again after a loss. In trading, with no formal end, you can become a passive loser. Just ignore a losing trade, let it drift, let the market take everything you own, and more.
oof. That passive slide sounds dangerous.
It's one of the most insidious parts.
So the gift of trading is this complete control, maybe for the first time ever. The curse is no external rules to guide you. That internal structure has to be a conscious choice, a deliberate act of free will. And our past experiences often make that incredibly hard. That really sets up the internal battlefield.
It absolutely does. And this leads right into 3 really deep-rooted problems for traders that stem from this mix of freedom and psychology. First problem, the unwillingness to create rules. Despite logic, despite knowing rules help, Douglas says he's not yet encountered a person interested in trading who didn't resist the notion of creating a set of rules.
Really? No one.
It's often subtle, this resistance. A quiet pushback. Intellectually, yeah, rules make sense. But deep down, we fight it. Why? Because most of the mental structure we have was instilled by others, parents, school, society, and often denied our freedom. Then trading comes along, this utopia of freedom, and we're asked to impose rules on ourselves. It's a conflict. Douglas says it usually takes a great deal of pain and suffering to break down the source of our resistance to disciplined trading. It's a battle against our own history.
That sounds painfully real for a lot of people. Okay, problem 2. Failure to take responsibility. Trading is pure, unencumbered personal choice with an immediate outcome. You choose, you act, you see the result. No one else to blame. But it feels like people want the freedom without the full weight of responsibility. How does that play out?
To get consistency, you must accept complete responsibility for every outcome, period. Avoiding responsibility usually leads to random trading, poorly planned, disorganized, letting unlimited variables influence decisions.
Why do people do that?
It's a psychological dodge. It lets you take credit for wins. See? I knew it. While blaming losses on external stuff. The market screwed me, or my broker was slow. Right. Here's a key paradox Douglas points out. The market isn't random in its patterns, but individual outcomes are uncertain. Patterns repeat statistically, but you can't know the outcome of this specific trade for sure. He gives examples of traders who plan well but then act on tips from friends, lose, and blame the friends, even though their original plan would have won. And the fact that any trade, even a random one, can be a winner, that just reinforces undisciplined behavior and makes it easy to avoid taking real responsibility.
Okay, number 3. Well, this is where it gets really interesting. Addiction to random rewards. It makes me think of those monkey experiments. Consistent rewards, predictable behavior, random rewards. The monkeys just keep pulling the lever forever. How does that hit us as human traders?
It's remarkably similar for humans, probably due to those euphoria-inducing chemicals our brains release when we get an unexpected, pleasant surprise.
Like a sudden, unexpected winning trade.
Exactly.
Yeah.
If a reward is random, we never know when it might hit. So the effort to try for that amazing, unpredictable win doesn't feel hard. It becomes highly addictive. That sudden rush from an unexpected win can just override all logic.
You forget the plan.
Totally. This state of choicelessness, this compulsion to keep chasing that feeling, diverts focus from vital things like building trust in your edge or managing risk properly. This addiction to the thrill is a huge source of resistance to creating the kind of mental structure that produces consistency. We chase the high, not the steady profit.
And this all ties into a bigger challenge: external versus internal control. Our whole lives were programmed for social interaction. We learn to control, manipulate, influence our environment and other people to get what we need.
Yeah, we negotiate, depend on others, try to sway outcomes.
But the market isn't social, is it?
Not even close. The market is a psychological wilderness. It doesn't know, care, or respond to our needs. It's completely impersonal. This is why many highly successful people great at influencing social situations often fail miserably at trading. Their usual strategies just don't work.
You can't sweet-talk the market.
Exactly. You can't control or manipulate it unless you're moving massive size. The only things we can truly control are our perception and interpretation of market information, as well as our own behavior. That requires a huge internal shift, letting go of trying to control the outside and focusing entirely on controlling the inside, yourself.
Okay, so let's circle back to that absolute cornerstone, taking responsibility. Sounds so simple. Own your results. But Douglas stresses how incredibly hard it is to do at a functional level. He says you literally have to create a new version of yourself, just as a sculptor creates a likeness of a model. What does that kind of ownership actually look like in a trader's mind?
It's about a deep transformation. Your willingness and desire to learn become your sculpting tools. Your beliefs and attitudes are the clay, the medium, and the primary goal, to learn how to think like a consistently successful trader, which boils down to trading without fear and at the same time keeps them from becoming reckless.
That balance.
Yeah. Douglas is adamant that this attitude produces better overall results than analysis or technique. It's the bedrock. Everything else, analysis, strategy, builds on top of it.
But that leads to a weird paradox, right?
Yeah.
Douglas observes, most traders are closer to the way they need to think when they first begin trading. Those initial wins create this carefree state of mind, kind of like being in a zone in sports. No fear, acting instinctively.
Beginner's luck.
Yeah, but it's not a developed attitude. It's fragile. So how do we capture that feeling deliberately, make it sustainable?
You're right. It's usually accidental at first, just a glimpse of what's possible. A real positive winning attitude isn't just blind optimism. It means expecting a positive result from your efforts, with an acceptance that whatever results you get are a perfect reflection of your level of development.
Accepting where you are right now.
Exactly. Douglas explains many people carry baggage from past pain, not getting what they wanted, feeling betrayed, punished for mistakes. This leads to an ingrained habit of externalizing blame, blaming something else. And that deep habit stops them from accepting responsibility for their own outcomes, which means they can't truly learn and improve from them.
If we connect that to the bigger picture, the market fundamentally is a zero-sum game. Your goal is to take money out. The market's sole purpose is to extract money or opportunity from you. It's this constant impersonal exchange.
And that's the critical point. If you're blaming the market, you haven't accepted it owes you absolutely nothing. Zip. The market just provides opportunities, price moves, information, ways to get in and out. Your outcomes, they are entirely self-generated, based solely on your interpretations, your decisions, your actions.
100% on you.
100%.
So why should you, our listener, really care about drilling this down? Why is taking total responsibility so crucial?
Because not taking responsibility inevitably creates an adversarial relationship with the market. And the second you see the market as the enemy, you're pulled out of the flow of opportunities. You see threats instead.
Right.
You also fall into the trap of thinking more market analysis, more charts, indicators, news will fix everything, when the real problems are internal. Like trying to fix a software bug by buying a faster computer, it won't work. This often leads to what Douglas calls the revenge trap. After a trader takes their first big hit, they usually shift from that carefree beginner mode to a prevent and avoid mindset.
Trying not to feel that pain again.
Exactly. They try to conquer the market with knowledge to avoid pain. But this means they start defining market info as painful if it goes against what they want to happen, which activates those pain avoidance defenses, rationalizing losses, blocking out contradictory data.
Like ignoring a clear downtrend because you're focused on tiny little upticks, hoping it turns around.
Precisely. That kind of self-deception. It leads straight to the boom and bust cycle and this deep feeling of self-betrayal. Opportunities get missed, losses compound, all because you're filtering out reality to avoid discomfort.
It really is like the market acts as a mirror reflecting what's inside back to you. If you come at it confident and clear, that's your internal state being reflected. If you're angry, scared, frustrated, that's because you believe the market creates your results instead of seeing how your internal state shapes your perception of the market.
It's a powerful, humbling thought. And interestingly, leaving money on the table missing a clear winning trade often hurts more than taking a planned loss.
Why is that?
Because, Douglas says, there's no way to rationalize the pain away. When you lose, you can blame the market, your broker, sunspots, whatever. But when you miss an obvious opportunity, the fault is clearly yours. That's tougher to swallow.
Makes sense.
So the most efficient path forward is to develop a winning attitude. And the absolute cornerstone of that attitude is embracing responsibility and stopping expecting the market to give you anything or do anything for you. The market just is. Your results come from you.
Okay, let's shift gears slightly and dive into the dynamics of perception and the power of association. This gets into how our inner world, our mind, actually shapes what we even see in the market, how our wiring affects interpretation.
Right. Our minds store memories, learn distinctions, beliefs, not just as passive data, but as active energy structures. These internal structures act like a force on our senses from the inside. They profoundly limit what we actually perceive from the outside world.
So our beliefs literally filter reality.
In a way, yes. Our unlimited capacity for learning often gets blocked by these existing internal structures. We simply cannot see what our current beliefs don't allow for.
You see that so clearly with a basic price chart, right?
Yeah.
A total beginner looks at it. It's just chaos, undifferentiated information, leading to confusion. But as you learn to spot trends, support, resistance, patterns. You start making distinctions. Those things were always there on the chart, but they were effectively invisible until you built the internal knowledge, the mental framework to see them.
It's like putting on special glasses.
Douglas uses the boy and the dog analogy here, which is really powerful.
Yeah, it illustrates the power of association perfectly. A kid gets bitten by a dog, forms a negatively charged memory. Next time he sees any dog, even a friendly one, tail wagging that negative memory instantly triggers fear. Why? The power of association. Completely. An unconscious mental function, a default reaction. The boy won't be able to perceive what he hasn't yet learned about, like the possibility of a friendly dog, unless he is in a state of mind that is conducive to learning. His mind just defaults to the known painful experience, blinding him to anything different.
And this maps directly, powerfully onto trading behavior. Think about the hesitation after a losing streak. You see a setup that fits your edge, but you perceive it as too risky. Or you even start looking for reasons not to take it, focusing on negative info.
Right. Or, the flip side, after a winning streak, overconfidence kicks in. The exact same setup suddenly looks like a riskless opportunity.
So you load up, take too much size.
Exactly. Same external situation, but the mind's associative baggage creates totally different perceptions and actions.
Which is precisely why consistency requires conscious control of the association process. You have to break that automatic link.
You have to be able to see the pure opportunity flow of the market without the threat of pain or the problems caused by overconfidence. You just can't afford to let past emotions dictate how you see the market right now. Every moment is new.
What's really wild is how our mental defenses literally blind us. Douglas says we often can't perceive a market moving against us if we're operating from a deep fear of being wrong.
Yeah.
The trend, the obvious opportunity to trade with the trend.
Yeah.
It doesn't become visible until we're finally forced out of our losing position.
It's a cruel trick our own mind plays.
It is. Douglas argues that making yourself available to what the market is offering means recognizing your current mental framework is probably limited.
You have to consciously open up to find out what will happen next instead of just assuming you already know based on the past, good or bad.
Be receptive, not predictive.
Exactly. That state of openness is what allows real learning and is crucial for entering the zone.
But staying in that now moment opportunity flow is hard. Two big hurdles seem to be. One, just staying present, not drifting to past wins-losses or future worries. And two, reconciling our rational mind with our creative or intuitive side. Our logical brain often distrusts those gut feelings, right? It wants proof.
Definitely. Douglas notes, there are few things in life more frustrating than recognizing the possibilities evident from a hunch and not taking advantage, because we talked ourselves out of it. That inner conflict is huge.
Yeah, I think everyone's felt that. Which brings us nicely to the market's true nature and thinking in probabilities. Douglas hits us with the market's most fundamental characteristic, that it can do virtually anything at any time.
And he argues, if traders truly deeply believe that at a functional level, there'd be way fewer losers.
So if we break down the market, it's just traders pushing prices around based on their beliefs about value, Price movement is just the balance or imbalance between those forces.
Yep. But there are always hidden variables. All the other traders, what they're thinking, their resources, their fears, constantly influencing things in ways you can't see.
Okay, this raises a really key question Douglas poses. How do casinos make consistent profits day after day, facilitating an event that has a purely random outcome, like roulette or dice? Well, most traders, who often think market outcomes aren't random, struggle so much.
It's a brilliant paradox, gets right to the core.
The paradox, random outcome, consistent results. How do casinos pull it off?
Yeah, casinos, pro gamblers, and the best traders, they all understand this. Events that have probable outcomes can produce consistent results if you can get the odds in your favor and there is a large enough sample size. It's a numbers game, pure probability, think blackjack. Casinos have maybe a 4.5% edge.
Tiny edge.
Tiny, but over tens of thousands of hands, a large enough sample size, they will make that profit consistently. They don't try to predict the next card. They trust the probabilities over time.
And the best traders, the really consistent ones, they use the exact same thinking as the casino. They aren't trying to predict individual trades.
No, they operate with these two layers of beliefs at the micro level. They believe in the uncertainty, the unpredictability of each individual trade. Every single trade is unique because of all those unknown variables, other traders, news, whatever. They accept they don't know what's going to happen next, for sure, on this trade.
Okay.
But at the macro level, they believe in the predictability of the outcome over a series of trades. That certainty comes from their known variables, their tested analytical edge that gives them a statistical advantage over time.
Got it. Micro uncertainty, macro certainty.
Exactly. So pros don't put any special significance, emotional or otherwise, on each individual hand or trade. They stay relaxed, they execute their edge, and they let the probabilities work out over a large sample.
So what's the direct takeaway here for you, the listener? Douglas tells that story about the brilliant analyst predicting a market low.
Oh, yeah, and then some semi-retired chairman just blows it up with one huge order, moving the market instantly.
Right. Shows how one trader, one unknown variable, can just negate your perfect edge on that one trade. It's humbling.
It really is. And these constant, never-ending, unknown, hidden variables are always there. The best traders factor them into their mindset. They don't pretend they don't exist.
Well,
The typical trader often acts like what they can't see or know isn't real.
which leads to those classic mistakes.
Forgetting to predefine risk, refusing to cut losses, not taking profits systematically. It's this psychological blind spot that leads to, as Douglas puts it, financial and emotional suicide eventually. To really get this probabilistic mindset, Douglas gives us the 5 fundamental truths about the market. Internalizing these is non-negotiable. 1. Anything can happen. Because of unknown forces, one trader, one event can wreck your edge on any single trade. No certainties.
Okay.
2. You don't need to know what happens next to make money. Focus on the edge over a series, not predicting the next tick.
Makes sense.
3. There is a random distribution between wins and losses for any given edge. Even with a great edge, the sequence, win, loss, loss, win, is random. You can't predict the order.
Right. No crystal ball for the sequence.
4. An edge is nothing more than an indication of a higher probability. It's not a guarantee, just better odds that one thing happens over another.
Probability, not certainty.
And 5, every moment in the market is unique. Patterns might look similar, but the underlying forces, the specific traders involved right now, are always different. History doesn't repeat exactly.
Wow. Okay, if you really truly believe in an uncertain outcome for each trade, if you internalize those truths, then you have to expect that almost anything can happen on any given trade. Rigid expectations. This trade must work. They become unrealistic and potentially damaging.
They trigger those pain avoidance defenses that block out reality. You can't expect to be right every time. The market doesn't care what you want.
Exactly. And adopting these truths deep down at a functional level, Douglas says it will eliminate your potential to define and interpret market information as either painful or threatening. And you thereby effectively neutralize the emotional risk of trading.
Neutralize the emotional risk. How?
Because if you truly accept uncertainty, you won't hesitate when your edge appears. No fear of being wrong. You won't jump the gun. No fear of missing out. You won't let winners turn into losers. No greed overriding your plan. You'll always be at least a little surprised by the exact outcome, which paradoxically keeps you open, keeps you learning, keeps you adaptable. You stop letting past trades dictate how you feel or act now. Each moment is fresh.
All right, let's unpack this even more. The core task isn't just knowing those 5 fundamental truths we just covered. It's about properly integrating them at a functional level, making them an automatic, natural part of who you are as a trader.
Yeah, like installing a new operating system for your trading mind. That sounds like a pretty huge undertaking.
It is, and it runs right into that deep paradox again. A pattern looks like repetition, consistency. But Douglas insists every market pattern is unique in its specific moment. Our association mechanism, linking now to the past, makes dealing with that uniqueness really hard. Our state of mind makes whatever we currently believe feel indisputable and beyond question.
Right, our feelings feel like facts.
Exactly. But the beliefs causing that feeling might be totally wrong relative to what the market can actually do. Think back to the boy and the dog. His feeling of fear was real, absolutely. But his belief that all dogs are dangerous wasn't universally true.
Okay.
So the ultimate goal isn't being right about every prediction. It's making money consistently. And that consistency is a byproduct of acquiring and mastering certain mental skills. It means trading in the now moment, totally free from the baggage of past emotions and expectations.
So where do these powerful beliefs actually come from? And what is it about them that makes them shape our trading so profoundly?
Douglas makes a distinction between pure memory, just raw sensory data, images, sounds, and a belief. A belief combines that sensory info with language to create an energized concept. An infant feels nurtured, memory, but only forms the belief life is wonderful when those feelings get linked to words and meaning.
Ah, okay. Concept plus energy.
Right. Similarly, life isn't fair can form from repeated disappointments linked to language. Beliefs are structured energy, and they fundamentally manage our perception, what we see, create our expectations, what we think will happen, shape our behavior, how we act, and crucially, shape how we feel about the results. And the kicker is, most of our deepest, most impactful beliefs, especially limiting ones, were instilled in childhood, not consciously chosen. And those are usually the ones causing the most trouble.
What's really fascinating is the inherent nature of beliefs themselves. Douglas outlines 3 key characteristics that explain their power. Let's dig into number 1.
First, beliefs resist any force that would alter their present form. They act like conscious energy. Think physics. Energy can neither be created nor destroyed. It can only be transformed. Same with beliefs. You can't just eradicate one.
Can't just delete it.
Nope. If you try to ignore or suppress a belief, it'll just force its presence and keep influencing you from the shadows, the effective way. Gently render them inactive or non-functional by drawing the energy out of them. Deactivation. Douglas uses Santa Claus. The concept still exists in his mind, but the active energy of belief is gone. He doesn't expect presence. The energy got transferred to a more useful concept of reality.
Okay, deactivate, not destroy. What's the second characteristic?
Second, all active beliefs demand expression. They don't all yell at once, but when something triggers them, they demand to influence our thoughts, feelings, actions. Think about holding back disagreement with your boss. The beliefs are still buzzing internally, demanding expression, right? Then maybe you unload later on someone else.
Yeah, it happens.
When our beliefs clash with our desires, like a belief about fearing loss, clashing with wanting consistent profit, it has a profound effect on our trading. Hesitation, self-sabotage. But Douglas notes, human consciousness is larger than our beliefs. We can have creative thinking outside those boundaries. A creative experience like the scared boy unexpectedly seeing friendly dogs having fun can directly conflict with a rigid belief. All dogs are dangerous.
So what wins? The old belief or the new experience desire?
Whichever has more energy. To deactivate a limiting belief like all dogs are dangerous, you need to create a positively charged experience. Maybe stepping through the fear, touching a nice dog, gradually transferring energy from the old fear to a new positive belief.
Okay. And the third characteristic, this one sounds a bit sneaky.
Third, and yeah, maybe the most insidious, beliefs keep on working regardless of whether or not we are consciously aware of their existence.
Yeah.
So much of what we learn operates subconsciously once mastered. Like driving a car, you're not consciously thinking about every little move after a while.
Right, it becomes automatic.
Douglas uses the scary example of drunk driving people can navigate complex tasks without full conscious awareness because the skills and beliefs are so deeply embedded. Similarly, self-sabotaging beliefs, I'm unworthy, I don't deserve success, can operate subconsciously, messing with our trading without us even knowing why we keep hitting roadblocks.
Which leads perfectly into the impact of self-valuation on trading. This suggests there can be this huge hidden disconnect between how much money we want, how much seems available, and how much deep down we actually believe we're worth or deserve.
Yeah, like a silent saboteur.
Exactly. How does this play out?
Self-valuation is basically the sum total of all our active beliefs, conscious or subconscious, that support or argue against our own success and deservingness. Douglas argues it's almost impossible to grow up without picking up some negative beliefs about deserving wealth.
Like what kind of things?
Subtle stuff from childhood. Money doesn't grow on trees. Or associating making mistakes with being punished or unworthy. Or even subtle religious messages linking wealth to being somehow less godly. These beliefs might be long forgotten consciously, but they still act at a subconscious level, mysteriously guiding our trading decisions away from large success.
What's really striking here is what Douglas calls the negative zone phenomenon. Traders who repeatedly hit a specific equity level, like a ceiling, have a big drawdown and then blame luck or the market. It's a pattern.
Recurring pattern.
He argues this is often unresolved self-valuation issues, acting out subconsciously, sabotaging success once they hit a certain internal comfort limit.
Exactly. Now, the good news is you don't necessarily have to dig up and deactivate every single limiting belief you ever acquired. That would take forever. But Douglas stresses you must be aware of their presence and take specific steps in your trading regimen to compensate when they start making noise.
So self-awareness is key, catching them in the act.
Yes. Developing the awareness to notice, there's that old I don't deserve this feeling kicking in, and then having a pre-planned way to manage its impact rather than letting it drive the bus.
Okay, so if I had to boil trading down to its absolute simplest form, I'd say it's basically a pattern recognition numbers game.
Right.
You use analysis to find patterns, your edge. You define your risk. You figure out when to take profits. Trade works or it doesn't. Move on.
Sounds simple when you put it like that.
Simple, yeah, but definitely not easy. In fact, Douglas says it's probably one of the hardest things you'll ever try to succeed at. Precisely because, and this is counterintuitive, the more you think you know, the less successful you'll be. How does that work?
It is counterintuitive, but it's a deep market truth. You have to learn to operate in a state of not having to know. Even if your analysis is spot on, even if the indicators are perfect, you still don't know the outcome of this one trade for certain. This requires properly managing your expectations. And how do you do that? By believing without a shadow of a doubt in the 5 fundamental truths we talked about.
Internalizing them completely.
Yes. It's this delicate dance. Accepting absolute uncertainty at the micro level while acting with absolute confidence in your probabilistic edge at the macro level. Detachment and conviction simultaneously.
So how does a trader actually evolve through this complex mental journey? Douglas lays out the 3 stages of trader development.
Okay, stage 1 is the subjective stage. This is where most people start. You're basically doing whatever you want with whatever you know. Driven by excitement, the lure of freedom.
Lots of impulse trades.
Tons. High susceptibility to all those errors. Self-valuation issues, fear, greed. Results are erratic. Emotional roller coasters, boom and bust cycles. Stage 2 is the crucial mechanical stage. This is where real discipline gets forged. It's rigorously rules-based. You consciously apply specific rules to your trading system. You meticulously track your adherence. You deliberately train yourself to be systematic, no deviations.
Overriding those gut reactions.
Exactly. It's about overriding natural impulses that lead to errors. It's not necessarily about being in the zone yet, but about building that ironclad foundation of consistent, disciplined action. Stage 3, the most advanced, is the intuitive stage. This is like mastery, the black belt level. But Douglas stresses you cannot try to be intuitive. True intuition is spontaneous. It doesn't come from deliberate rational thought.
Our rational mind distrusts it anyway.
Right. It wants proof, logic. Douglas notes how many traders get strong hunches but talk themselves out of them rationally. The key is to train our minds to accept and trust creative information. You set up the mental conditions for intuition by building such a solid mechanical foundation. Then, when intuition does arise, you can act on it instantly without inner conflict because the discipline base is already there.
And at the absolute heart of this whole transformation, this psychological journey, is creating the belief, I am a consistently successful trader. Douglas says this isn't just wishful thinking. It's a powerful, energized concept that will literally reshape your perceptions, interpretations, expectations, and actions. How on earth do you build a belief that powerful, especially if it clashes with existing ones?
Well, it will almost certainly conflict with some of the beliefs you've already acquired about yourself, money, success, whatever. It's an energy dynamic, just like the boy wanting to play with dogs despite his fear, or Douglas wanting to become a runner despite his initial struggles. It requires an active process of transformation. You have to gradually deactivate the conflicting beliefs, draw the energy out, and strengthen the new one through consistent action that supports it.
Action reinforces belief.
Exactly. It demands your willingness to change, total clarity of your intent, and real strength of your desire. Douglas emphasizes ultimately for this to work, you must choose consistency over every other reason or justification you have for trading.
Consistency above all else.
It has to be a deliberate, disciplined, unwavering choice, reinforced every single day through your actions.
Okay, so with that as the big goal, how do we build this framework practically? Douglas gives us the 7 principles of consistency. He says these aren't optional tips. They're the non-negotiable building blocks for that winning mindset. Let's break them down.
Okay, principle 1. I objectively identify my edges. Objectivity means seeing market info without it being colored by potential pain or the thrill of euphoria. Keep expectations for any single trade neutral. Always factor in those unknown forces. You have to train your mind to be objective and to stay focused in the now moment opportunity flow.
Because every moment is unique.
Exactly. That's the market's truth. The illusion of familiarity, thinking this looks just like last time, so it must do X, that's what leads to all the typical errors. Hesitating, jumping the gun, not defining risk, not cutting losses, cutting winners, letting winners become losers, all stem from emotional distortion, not objectivity.
Believing every moment is unique. How does that actually change what a trader does day to day, beyond just knowing it?
Great question. It means you don't carry the baggage of the last trade, good or bad, into this moment. Each new setup, each new price bar is a completely fresh slate, unburdened by what just happened 5 minutes ago. Be fully present now.
Got it. Which leads right into number 2. I predefine the risk of every trade.
Yeah.
This feels like an absolute bedrock principle. Douglas says if it takes any special effort, any reminder,
then this principle is not a dominant functioning part of your identity. It has to be automatic.
He uses that amazing analogy of walking on a bridge over the Grand Canyon.
Yeah. Taking bigger positions makes the bridge narrower, less room for error. A tiny misstep or slight gust of wind, a distracting thought, a market wiggle, an emotional flinch can be catastrophic. Huge losses, giving back big wins. It's the most common error because it forces you to face being wrong or losing money, which we instinctively hate.
That Grand Canyon image really sticks. Comfort with risk isn't ignoring it, it's predetermining it. Which takes us to number 3. I accept the risk completely, or I am willing to forfeit the opportunity. No rationalizing, no justifying after you're in. Why is accepting it so hard?
Because eliminating errors means admitting mistakes. And for most people, that's deeply uncomfortable. Douglas challenges the idea that we inherently ridicule ourselves for errors. He says great athletes don't fear mistakes. They see them as feedback, pointers for growth.
Unlike most of us.
Right. We often grew up associating mistakes with shame, punishment, feeling like a screw-up. If mistakes are negatively charged in your mind, you'll instinctively avoid admitting them, which blocks learning. True risk acceptance means being okay with the loss and learning from it without beating yourself up.
Okay. Principle 4. I act on my edges without reservation or hesitation.
This flows directly from accepting the risk. If you've genuinely accepted the potential loss for this trade, if you're truly okay with it, then there should be no internal fear or conflict stopping you from executing your plan the second your edge appears.
So hesitation means you haven't really accepted the risk for this trade.
Exactly. You're still secretly hoping for certainty, trying to predict, not playing the probabilities.
Principle 5. I pay myself as the market makes money available. This sounds practical, but also psychological.
It is. Douglas learned this from his own trading analysis. He found he rarely got stopped out instantly. Usually the market moved a few ticks in his favor first, like only 10% were immediate losers. The other 90% often moved 3-4 ticks his way before maybe reversing.
Interesting observation.
So his strategy became take a portion off, say, 13 of the position for a small predefined profit early, like 4 ticks on bonds, 1.52 points on S&Ps. This immediately reduces total risk on the rest. Then, crucially, move the stop on the remaining position to the original entry point.
Creating a risk-free opportunity.
Yes. He cannot stress enough how important it is for you to experience the state of risk-free opportunity. It creates a profoundly relaxed, carefree state of mind. Think about panicking out of a winner that pulls back versus staying calm because you banked some profit and the rest is risk-free. Huge difference.
Yeah, totally different feeling.
The last 13 is then held for potentially bigger moves, but without the pressure and without trying to squeeze the last tick.
Beyond the money, what's the deep psychological win from securing that risk-free opportunity? Seems like it would lift a huge weight.
Oh, it's massive. It instantly changes your relationship with the rest of the trade. It goes from fear of loss to pure potential. You can genuinely let it run, let the market show you what it can do, because emotionally, you've got nothing to lose on that portion now. It breeds patience, allows you to capture bigger moves without the usual knot in your stomach. It's key to cultivating that relaxed, objective state.
Okay, number 6. I continually monitor my susceptibility for making errors. Constant self-awareness.
Yeah. If you notice you're losing focus, thoughts drifting, feeling tempted to break a rule, you choose to redirect your thoughts, words, or actions back to your plan consistently. This is self-discipline, a mental technique to redirect our focus to the object of our goal. When that goal conflicts with some other component belief of our mental environment. His story about becoming a runner is perfect here. Started in 78, 79, low stamina, constant negative thoughts, too hot, pre-tired, pointless.
Hobbling himself.
Totally. He made a 5-mile rule run at least one step farther than last time, no matter how he felt. Eventually, those conflicting thoughts just faded away. Being a runner became who I am. The consistent discipline dissolved the conflict.
That's an incredible example of transforming internally through consistent action. Discipline is gentle, persistent redirection, not brute force.
Exactly. And finally, principle 7. I understand the absolute necessity of these principles of consistent success and therefore never violate them. These aren't nice ideas. They're the non-negotiable foundation.
Got to treat them like commandments.
Pretty much. Trading like a casino means set rigid variables for your edge, accept the fixed odds, and commit to taking every single trade in your defined sample size, say 20 trades, that meets your criteria. No picking and choosing based on feelings. That lets emotion in. You adjust position size, use minis, fewer shares, so you're comfortable with the total risk across the whole sample, but you don't change your risk parameters for an individual trade, like your stop loss, unless the setup technically warrants it.
Consistency across the board.
Yes. Douglas strongly suggests practice using simulated brokers like AudiTrack.com, no real capital risk. This disciplined practice will create a head-on collision between your desire to think objectively in probabilities and all the forces inside you that are in conflict with that. The key is relentless self-discipline. Write down the 5 truths, the 7 principles. Repeat them with conviction. Acknowledge the conflicts when they arise. Don't ignore them. And keep refocusing, keep redirecting until they become automatic, until they just are who you are as a trader. Hashtag outro.
So wrapping up this deep dive, the core message from Mark Douglas really couldn't be clearer, could it? Mastering trading isn't really about outsmarting the market, finding the holy grail indicator, or some secret formula.
Yep.
It's fundamentally about mastering yourself, building that solid, resilient internal mental framework, the one that lets you act confidently, with discipline, right in the face of constant uncertainty, embracing probabilities, accepting risk.
Yeah, it's about understanding your mind is your number one asset in this game. And like any asset, it needs managing, training, and yeah, sometimes debugging. Your beliefs, your attitudes, that's the software running your trading. Change the software, you change the results.
So, as you reflect on everything we've talked about today, maybe consider, what specific beliefs might you be holding on to? Beliefs that might be secretly sabotaging your potential, pulling you away from that consistent discipline you need. And just imagine, what might it truly feel like to trade without that fear, to fully embrace the uncertain outcome of every single moment, knowing you've mastered your own inner game.
We definitely wish you great prosperity and success on your trading journey. And remember what Mark Douglas would say: you really won't need luck if you put in the work to acquire the appropriate skills.